Good day, everyone. Today, we are going to take an in-depth look at one of the most critical aspects of transfer pricing. Module 13, Economic Analysis in Transfer Pricing. So, it's one of the most critical aspects of transfer pricing. As you know, transfer pricing is about determining the price for intercompany transactions in compliance with the arm's length principle. So this means the pricing between related parties must be comparable to what would occur between independent entities. But how do we ensure that these control transactions are in line with this principle? The answer lies with conducting a robust economic analysis. So over the next minutes, we will discuss how to conduct this analysis, the steps involved, and practical examples or case studies from various industries to make the concept tangible. So, before we dive into the steps, let's set the foundation by understanding the role of economic analysis in transfer pricing. At its core, the economic analysis ensures that intercompany transactions between related parties comply with the arm's length principle. So this is very, very critical, not just from a compliance standpoint, but also to avoid significant tax adjustments and penalties. So what does economic analysis involve? It includes evaluating the economic functions performed by each related entity, the assets used in the transaction, including both tangible and intangible assets, the risk assumed by the entities involved. Once these elements are evaluated, we can proceed to select the appropriate transfer pricing method. Moreover, we must ensure that any adjustment necessary to enhance comparability between controlled and uncontrolled transactions are made. We will explore this in detail. Now that we have set the foundation, let's move to step-by-step process of conducting economic analysis for transfer pricing. And the steps, we have number one, functional analysis. Functional analysis is identifying the value drivers and economic activities of the entities involved. Industry analysis is understanding the external economic environment in which the business operates. Now, economic analysis method, selecting the most appropriate transfer pricing method to determine the arm's length price. Each step is very critical in ensuring that we achieve accurate and compliant transfer pricing outcomes. So it is really, really important. Now, it is really important to look at those transactions. Now, the first step is with respect to functional analysis. I'm now trying to break it down again, is that the first step is to conduct a functional analysis. This is the backbone of economic analysis because it helps us to understand the role each related entity plays in a control transaction. The functional analysis covers three main areas. Which is identifying functions, to identify functions. Now, we must clearly define the specific function each party in the transaction performs. Functions can range from manufacturing, distribution, research and development, marketing, procurement, and even more. But we need to understand the functional profile of each entity, which is very vital in determining the pricing of transactions. For instance, a company performing high-value functions such as research and development or marketing typically commands a higher return compared to a company engaged solely in routine manufacturing or distribution. Now, with respect to asset use, the second aspect is evaluating the assets involved in the transaction. This includes both tangible assets such as machinery or inventory and tangible assets, or even intangible assets like intellectual property, patents, brand value, or proprietary processes. For example, if one entity contributes a significant tangible asset like a patented technology, these assets will greatly influence the value of the transaction and the profit allocation between entities. Now, we also need to look at, evaluating risk. I'm still talking about the functional analysis now. We've looked at identifying the functions. We've looked at to assess the assets. We've also looked at evaluating the risk. Okay, now let's look at the evaluating the risk. Sorry. Now, lastly, we need to assess the risk borne by each entity. Risk can include market risk, operational risk, credit risk, inventory risk, and even foreign exchange risk. Foreign exchange risks, if you look at the way naira is being devalued and the exchange difference and all that, which is causing a lot of issues for manufacturing industry especially. So foreign exchange risk, it is essential to also remember that entity assuming greater risk in a transaction should, in theory, receive higher returns. For instance, if an entity bears the market risk, if an entity bears the market risk of fluctuations in demand or prices, it should expect higher profitability compared to a low risk entity. Now let's move to industry analysis. After completing the functional analysis, the next step is to conduct an industry analysis. This analysis helps us understand the broader economic environment in which the taxpayer operates and ensures that transfer pricing reflects the realities of the industry. The industry analysis also includes that first we must analyze the industry's competitive landscape, regulatory environment, and market conditions. Transfer pricing is not conducted in isolation, so it is influenced by a lot of external factors such as regulatory changes, fluctuation in supply and demand. Now, technology advancement and shifts in consumer behavior is also part of it. For example, transfer pricing or pricing is a highly regulated or pricing in a highly regulated pharmaceutical industry should differ significantly from that of a fast-moving consumer goods. Now, under the industry analysis, we also have benchmarking, which is also very crucial. It is crucial to benchmark taxpayers' performance against industry standards. Benchmarking is a method of comparing the performance of related parties to that of independent entities in the same sector. This ensures that the profitability of the related entities is consistent with what independent parties in a similar economic position would have achieved. For instance, if industry benchmarks shows that independent manufacturers typically achieve a 10% profit margin, this will guide our analysis of whether the taxpayer's margin is at arm's length. So industry analysis is very, very crucial. Now, once we have conducted both functional and industry analysis, the next step is to select the appropriate method. Now, once we have conducted functional and industry analysis, the next step is to select the appropriate method of the transfer pricing that we are using, or to determine the arm's length. Different methods are used depending on the nature of the transaction and the availability of comparable data. So we're going to view, let's review the most common transfer pricing method here. Before we move here, let me see. Okay, let's look at the most used method. Comparable controlled method or comparable control price method. This method compares the price of a controlled transaction with the price of a similar transaction between independent parties. It is considered one of the most reliable methods when comparable uncontrolled transactions are available. For example, if a company licenses a patent technology to a related party, we can apply the COP method by comparing the licensing fee with that of an independent third parties would pay for a similar technology, or by comparing the licensing fee with what an independent third party would pay for that similar technology. Now, with respect to resale method, Resale method is often used when goods are purchased from a related party and then resold to an independent party. We begin with the resale price to the independent party and conduct an and sorry, let me take that again. Resale price method is often used when goods are purchased from a related party and when resold to an independent party. So we begin with the resale price to the independent party and deduct an appropriate gross margin. So this method works well for distributors who purchase finished goods from a related party and then resell them without making substantial changes. Now, cost plus method. Cost plus method involves adding a reasonable markup to the cost incurred by the supplier in providing goods or services. This method is typically applied in scenarios where the supplier performs routine low-risk function such as contract manufacturing or routine services or routine service provision. Now, for example, if a Nigerian subsidiary performs low-risk assembly work for its parent company, we would use the cost plus method to calculate the appropriate markup on its cost. Transactional net margin method. The TNMM examines the net profit margin earned by a related party related to an appropriate base, such as costs, sales, or assets. The transactional net margin method is widely used when it is difficult to find reliable comparables for the COP resale price method or the cost plus methods. In practice, the TNMM allows us to look at the overall profitability of the entity, ensuring that its net margin is consistent with what independent entities in similar circumstances would achieve. Now, with respect to the profit split method is often used in complex integrated operations such as global supply chains or joint research and development projects where both parties make significant contribution to intangible assets. This method splits the combined profits from intercompany transactions based on the relative value of the contributions made by each party. For example, in a joint research and development arrangement between related entities, we would apply the profit split method to ensure that each party receives a fair share of the combined profits based on their contribution. So we've looked at that also. It's just to explain all these things again for our understanding. And now let's look at the economic adjustment. After selecting the appropriate method, we must often make economic adjustments to ensure comparability between controlled and uncontrolled transactions. Why are these adjustments necessary? Because real-world differences such as transactional size or transaction size, geographic location, and functions performed can distort the analysis. So these adjustments ensure that controlled transactions reflect the arm's length principle as closely as possible. So let's take a closer look at the different types of economic adjustments that may be necessary. Volume adjustment. These adjustments account for differences in transaction volumes. Now, a large-scale transaction may benefit from economic of scale, while a smaller transaction may incur higher per unit costs. For instance, a company selling 1,000 units of a product will likely offer lower prices per unit compared to a company selling 100 units. So when making adjustment, you need to look at the volume also. Now, geographic adjustment. Geographic adjustment take into consideration the economic differences between countries or regions. Market conditions, consumer purchasing power, and regulatory environment can vary significantly, necessitating adjustment. For example, selling the same product in Nigeria and Germany, that means you are looking at West Africa and Germany, which is in Europe, may require different pricing strategies due to differences in economic development and consumer behavior. Now, with respect to functional adjustment, sometimes these functions performed by the related parties differ from those performed by independent comparables. If the controlled entities perform a more critical function, such as product development, compared to an independent comparable, we will make a functional adjustment to account for this. Now, timing difference or timing adjustment as well. Transactions occurring at different times may be impacted by economic fluctuations, such as changes in exchange rates, interest rates, or market demand. Adjustment for timing difference are crucial in ensuring that we compare like with like. Now, contractual terms adjustment too. The variation in contractual terms such as payment schedules, credit periods, or warranties can significantly affect transaction pricing. For example, if one party in the controlled transaction offers extended credit terms, this would require an adjustment compared to a comparable transaction with standard payment terms. Now, looking at the process for making adjustments, the process of making adjustment involves three critical steps. One, you need to identify the differences. The first thing is to identify the differences, identify the material differences between controlled and uncontrolled transactions that would impact comparability. This may involve differences in the size, scope, or terms of the transaction. Then quantify the adjustments. Once we have identified the differences, the next step is to quantify their effect on pricing or margins. For instance, geographic adjustments could involve adjusting the gross margins based on purchasing power parity (PPP) between countries. Now, document adjustments. Finally, it is crucial to document the adjustment in detail. This includes explaining the rationale for the adjustment, the methodology used, and any data sources relied upon. Documentation ensures transparency and auditability, which is critical during tax audits or disputes with tax authority. Now, looking at the practical, or looking at the case study. Now that we have gone through the theoretical framework, let's apply this knowledge to practical scenarios. I will present three examples from different industries: manufacturing, retail, and pharmaceutical, to demonstrate how economic analysis is conducted in real-world situation. Now, with functional analysis in the manufacturing sector, in this first example, we have ABC Manufacturing Limited, a Nigerian subsidiary that manufactures products for its German parent company. The company uses the cost-plus method for transfer pricing. Here is how the functional analysis is conducted. ABC Manufacturing is responsible for production and quality control. The company utilizes specialized machinery and proprietary processes, which are key assets in this transaction. ABC also bears operational risk related to production efficiency and product quality. Based on the functional analysis, the appropriate markup on cost is determined by benchmarking against independent manufacturers performing similar functions and using similar assets. Adjustments are made to account for differences in geographic markets and production volumes. The geographic market, we're looking at Nigeria versus Germany now. Now, geographic adjustments in the retail sector. Our second example involves XYZ Retail Limited, a multinational retailer that sells products to subsidiaries in various countries. The company applies the resale price method for transfer pricing in this case. Now, the gross margin in country A are higher than in country B due to different economic conditions and consumer purchasing power. This geographic difference directly impacts pricing, and without adjustment, the margins would not be comparable. XYZ Retail makes appropriate adjustment to reflect these changes or to reflect these differences. Now, these adjustments are thoroughly documented, including market data and economic analysis justifying the pricing differential. Now, example 3, we're looking at the comparability analysis in the pharmaceutical industry. Here, we examine PQ Health Pharmaceutical Industry, a Nigerian pharmaceutical company that licenses its patented drugs to related entities. The company uses the comparable uncontrolled price method to price its licenses. The functional analysis reveals that PQR Pharma focuses on research and development, while the related entities handle manufacturing and distribution. The COP method is applied by comparing the licensing fees to those charged in comparable transactions between unrelated parties. Adjustments are made to account for differences in market conditions and regulatory environment between Nigeria and the other countries involved. So this ensures that the pricing remains arm's length despite geographic and regulatory um, differences. Now, to wrap up, conducting economic analysis in transfer pricing is not just about following a formula. It requires a comprehensive understanding of the economic functions performed, assets used, and risk assumed in intercompany transactions. By applying the right method and making appropriate adjustments, we can ensure that the transfer pricing policy adheres to the arm's length principle. So the key takeaway here is that meticulous documentation is critical to managing transfer pricing risk and ensuring compliance with global regulatory standards. The examples we covered today, from manufacturing to pharmaceutical, shows how economic analysis plays out in practice, reinforcing the importance of a structured and well-documented approach. Thank you very much for your attention. Thank you.